differ. And loss is the manifestation of risk. When the risk finally comes to fruition and you book it, then it becomes loss.
Come again for loss.
So loss is when risk is manifested. Supposing there is a risk of losing 10% in the stock market, but when it comes into reality, then you lose 10% of your portfolio. So that is loss. Loss is material and real, while as risk
So
is
you can
more
say
material.
realized risk is loss. Okay.
Yes,
Or
sir.
realized uncertainty is loss.
Yes.
Now all these risk management models has been developed to reduce the risk or to protect the risk. Okay. Either we go for different hedging strategies using derivatives, or we calculate different margins or risk strategy based on this bar or extreme loss margin or span margin. There are so many margins that are used in the market. The idea is to protect the interest of the investor, or to give an indication whenever loss is keeping on increasing, or one can expect maximum this much loss can come in my investment. Okay. Now how we measure this risk? We measure risk through standard deviation. Yes or no? We measure risk through standard
Yes, sir.
deviation. Now if I will measure through standard deviation, what type of risk I measure? This is called uh,
Dispersion risk.
dispersion risk, or you can say unconditional risk. Okay. Unconditional risk. And what is the conditional risk then? The conditional risk management or risk measure comes through time series risk measures. Okay. You might have covered the time series volatility models.
I don't think so, sir.
That means you are going to cover. Still, the syllabus is not over, right?
No, sir, not yet over.
No, it is there. Actually, always these volatility chapters are there in the last unit because you have to study all those co-integration or VAR or ARMA or ARIMA. Then you will move to volatility models. So this is called conditional volatility or conditional risk. Okay, conditional risk. Now the question is whether we are ready to take any risk or not. In the market, whenever you participate, are you ready to take any risk?
So that would depend on what kind of reward we are looking for.
Okay. So if that is so, it depends on how much reward I'll get. Suppose I am traveling, or I am say whenever we sit also there is a risk. Whenever we walk there is a risk. Whenever we eat there is a risk. So risk is there in every part of our life. It depends, the amount of risk or the quantum of risk differs from the circumstances to circumstances. Whenever especially we participate in the financial instruments, either you start from fixed deposit. People used to say fixed deposit is riskless, but you have realized that fixed deposit has risk. Yes or no? You have seen the so many banking crises, including Yes Bank, PNB, banking scams. So they are, even if you have fixed deposit, you are not allowed to withdraw in a certain period. There are lock-in things. Then not only lock-in things, they don't have sufficient balance to pay you. So that was also the case. But the amount of risk in fixed deposit is less. If we keep on going or keep on moving towards towards different instruments, we come out with higher return or higher risk. So if you place those instruments into risk return characteristics, so which will be high risky or high return?
So that depends which investment is like say penny
Suppose,
stock.
yes, suppose we'll take fixed deposit, FD. Then you take money market instruments. Okay. You take T bills or you take commercial papers. Then you take bond, yeah, or bond fund you can take. So before this money market fund means the mutual fund scheme of money markets, money market instruments. Then bond fund means the long-term bonds, mutual fund schemes. Then you come bond, then equity fund, then equity. Okay. If you take this side risk and a y-axis return, if you keep on taking small amount of risk, your return will be also come accordingly. That is why we say higher risk gives us higher return, but this doesn't appear always. Maybe higher risk may give lower return as well. Yes, Mihir.
Sir, where do REIT and InvIT rank on the risk perception?
Okay, REIT and InvIT will come in between bond and equity. Okay. Either you can place in the bond fund only, uh, bond fund between bond fund and bond. Okay. So you can keep it in between that. So that is less risky as compared to direct investment, but even so even it's a fund, it has a risk. So that's why in all mutual fund advertisement you are getting like mutual fund investment is subject to market risk. This REIT and InvITs are the innovative products that are helping the investors to take a longer position or a, get a ownership of a larger project. Suppose say a shopping mall, you will not able to contribute to totally, you will not able to own the shopping mall, but part of the investment you can contribute. So that's how REITs and InvITs has been developed. Okay. So we are taking some amount of risk in the market. That's why we are always examining how to reduce this risk. Okay. Now, if you see, there are so many Nobel laureates. They have developed so many risk management tools or risk management models. Those models are in place, like risk adjusted return or the introduction of derivatives or the risk management mechanism, or we call that as risk management system. Okay, so based on risk management system, we reduce the risk of huge losses. We give a limited loss, but still again it may go beyond VAR. That's why VAR is the maximum loss, but we have another scenario that is beyond VAR. So what is VAR, all of you are aware, but still we'll just revise what is VAR. Then we'll see what is historical VAR and parametric VAR, then Monte Carlo VAR. Whenever we do this VAR, we do back testing and stress testing. Any model you do, you can back test and see the uh, correctness of that forecasting or that model's calculation. So back testing helps us. Then testing and scenario analysis will look into. So beyond that, we have some other risk measures. Okay. Other risk measures. There are so many other financial experts. They have given some of the risk measures other than VAR or extreme loss margins. So we'll also learn that what are other risk measures other than say your existing VAR or extreme loss margin. Okay. Now, as all of you are aware, we estimate like VAR estimates the loss from a given position over a fixed time period that will be equaled or exceeded with a given probability. So I'll say in one day how much loss will come and what is the probability that that loss will come in 2 days or in 5 days. So we calculate 1 day, 2 days, 5 days VAR, 10 days, 15 days VAR. Then VAR has two equivalent interpretation. One is worst case loss, that is how Neil and others were telling. So over 1 day, there is a 95% probability that we will not lose more than X% or Y%. Then another is an unlikely event. On average, in out of every 20 days, we should expect to incur a loss greater than or equal to a certain amount. Okay. Either we will take 1 day loss or over a period of time, if any events are happening, then we can come out with some certain amount of loss. So take one example. Just spend half a minute and go through this example. Can anyone say what you have learned here? Anyone?
So
Neil?
we calculated the
Yes, Meir.
risk and translated into the VAR. So like 15% probability, there is 5% probability.
Hmm.
So the loss, we calculate the loss at 15,000. So that way. I'm finding it difficult to put in words. I understood the concept, but I'm finding it difficult to explain.
So
Okay.
when it comes to
Sure.
probabilities, yes, Sherry, go ahead.
It's okay. I was just saying that there is 5% probability that he would earn 10% of interest rate, and there is 95% probability that that he would lose something, but that won't exceed from 15,000. So 5,000 loss is the maximum loss he would get.
5,000 or 15,000?
So
15,000.
Yes.
given the fact it's a continuous distribution, what we would expect is around, we are expected to get around 10%, which is around the mean. However, when we're talking about this continuous distribution, at our worst case scenario, there is only a 5% chance that we get less than 15% returns, minus 15% returns. And so, as you mentioned, the worst case scenario or the other way of seeing it is a very unlikely event. It is very unlikely that somebody will get less than 15% from this investment.
Yes. so Neil has told it very correctly. See, 15% bhar we are getting. That means 15% loss will come. So that is the maximum loss we say. But what is the probability that this much maximum loss will come? That is the 5% probability, because at 5% it is significant. So we are in the 95% confidence interval that it will not come 15%, but 5% chance is there it will come. Now if I will know this, how do I use for my investment or my portfolio? How do I use this?
People who are risk averse should go with portfolios or investments which have high VARs.
IVR. Come again, Neil.
People who are risk averse, they should go for portfolios or investments which have high VARs. Like let's
High
say,
VAR or low VAR?
uh,
Risk averse.
yes,
Yes.
sir, high VAR. So like let's say me, if I'm getting a stock whose worst case scenario is 10 is let's say 1%, and there's a stock which has a worst case scenario of -3%, I would like to go with the 1%
Yeah,
highest.
that is low risk you have.
Minus, Neil, it's in negative, so the minus would be higher.
Sir, I guess Neil inversely said it, like opposite of what.
Yeah,
Yeah,
he's
yeah. What Neil is saying, Neil has understood, but he's placing in a different way. Yes. Can anyone place it?
Uh,
so a person who is risk averse would go for investment which have a low VAR. So the risk is low, so that's why the averse person would go there. And if a risk lover person would go with, yeah, okay, Neil, you can go ahead. Sorry.
no, no, complete.
Yeah, so a risk lover person would go for a high VAR since the risk is more and the returns would be more. Like
Risk
that.
averse person or risk
It's a risk lover person. Risk
risk,
averse
yeah,
person
yeah.
would go
So
for
we
this.
call it as risk takers or risk lovers. Okay. Okay. See, uh, there are certain category of investors. They always select to invest in penny stocks. We are keeping away from the penny stocks, but there are certain investors, they always takes that much of risk. If loss will be there, huge loss will be there, or profit will be there, at least 500, 600% profit will be there. So investors are categorized into two types. One is risk averse and another is risk takers. So those risk averse, they don't want to take much risk. I don't want to take much risk. I don't want to lose my own money. Whatever small percentage of return that is coming, I am happy on that. But on the other side, there are risk takers. They always want to take risk, even if there is chances of losing huge amount of money, but chances of getting huge amount of money is also there. So they take a huge amount of risk. Now, if I am getting the bhar which is having, I'm getting the bhar which is having high bhar or low bhar. Okay. So you can see this bhar is V small a r. In time series, I think you have covered something called V capital A R. That is called vector autoregression. Have you covered this?
No, sir, we haven't.
Okay, so you will cover that vector autoregression, but that bar is capital A and this bar is small a. That is huge difference between V small a r and V capital A r. So V capital A r is a time series model for forecasting purpose, but V small a r is for risk management purpose. Okay, so I always want to understand my bhar, percentage of bhar, before I go for investment, or whenever I have invested, I'll check how much maximum loss I can come or I can get from this investment. Yes, Neil.
So just a doubt, in the same example which you have given, if you're given three choices, sir, investment A, which has a VAR of positive 3%, a VAR of minus 15%, and a VAR of minus 25%, which one would you select, sir?
So positive 3, then minus 15%, then minus 5%,
Minus 25.
25%.
So
So which one?
I'm giving your example, and one is plus. Your example is minus 15, plus 3, and minus 25.
Okay.
So which one would you select, sir?
Yeah. So can anyone say which one will select?
So if you are a risk averse person or risk taker person,
Okay, risk takers.
risk takers would take minus 25.
Okay, risk averse.
3%.
Okay, 3%.
So,
Yes, Muskan. Yes.
so can value at risk be a positive percentage? Because it is telling us what is the value at risk, what is the value we will lose. How can it be positive then?
Okay. Neil, how can it will be positive?
Sir, I can give a very good example. Sir, we can say, let's say I take a government bond. All right. So what is the going rate for the government bond right now? And if you could just give me some number.
Yeah, 6%, 6.7%.
So 6%. So, sir, it is highly unlikely that I will get 4% out of this investment. So my value at risk is 4%.
Okay. Thank you.
That is how I'm seeing it.
Yes, yes.
Also, Cherry, as you mentioned, that risk level and risk averse person will take 3 minus 25. I made a mistake in mentioning risk averse in my first time when I was giving the answer, but I don't believe that value at risk gives us any information regarding the mean and the standard deviation separately. So given no information,
No.
I think any rational person would just take a VAR of 3%, and I don't think anyone should have any reason to take any investment with VAR of minus 25%.
Okay. Yes, you are correct. Here will not give you any return part, but you need to take, whenever you take decision, you need to see how much return you can generate from this investment as compared to how much VAR it is coming, or as compared to how much downside risk you are coming in. Okay. So this return will be not given by value at risk, but you can have you can calculate your return considering the historical data. Okay. Now this VAR is widely used. We have something called VAR margin. If you have all of you have come across, have you heard about this VAR margin? VAR margin. So this broker funds gives us one warning whenever we keep on we do trading and our losses are keeping on increasing. They will say you are crossing with VAR margin, so additional margin you should bring, or VAR loss you are exceeding. So for each of the investment, VAR margin is getting calculated. Another is span margin. Another is extreme loss margin. What is this span margin? This span margin takes VAR margin takes one scenario. Span margin takes 16 scenarios, 16 worst scenarios. Yeah, worst scenarios. Then it calculates the VAR, like it's a it will take worst 16 scenarios and calculate whatever will be the maximum loss or maximum VAR of that particular investment, and that will be used for our as a representative of maximum loss. So span margin has again a wider used. This there is a MSCI Morgan Stanley has developed this span margin, and now all over world or all over the exchanges they are using this span margin. The idea is to reduce the default in the market or reduce the risk in the market, so that will indicate that you are crossing the span margin. Whenever your loss levels are keeping on increasing, always you are getting one notification. Even you have to bring some additional amount of margin if you are going beyond the stipulated margins or stipulated risk. So the system of exchange system has also a automatic calculation of this bar margin, span margin, and extreme loss margin. Based on that margin, requirements are being collected from the clients. Before it was collected from the broker houses, so now it is collected from the clients. Now basically it will say within a stated probability how much loss it can come. The actual loss that could be incurred could be higher, but it may be the same. It carries with a stated probability. So we want to increase the confidence interval so that lower the probability. Then it calculates with a specific time period. Okay. Whenever we bring about these types of VAR, we have historical VAR, then analytic VAR or parametric VAR, then Monte Carlo VAR. If you see, historical VAR is having some assumptions. So normality assumption is not required for historical VAR. It works on historical returns. How do we calculate this historical VAR? Once we collect data on historical return or of a asset or portfolio, then return should be measured over a time interval that is equals to desired VAR time period. So then from this information construct a histogram of historical return data. VAR is the return associated with the cumulative probability from the left tail of the histogram. So what are the advantages of this historical VAR? Because it is non-parametric, historical method doesn't require normality assumption. It's easy to understand, and it is and implement, and it based on the historical information. Now disadvantage is history repeats itself, same return distribution you'll get. Then you may get a biased estimate for forward-looking VAR, taking the historical return of 10 years bond misleading as duration was higher years ago, or 10 years was high. If you bring for for 2 years more, then you may get a you may get a biased estimate, because each period is following a certain business cycle. We don't know the next period will follow that type of business cycle or not. Again, if you look into during the emergencies like COVID, or during say financial crisis period, that those are the again extreme events we should avoid. So we should avoid means we should calculate in a separate way, because that are the period which are not same as the normal period. Okay. Now we'll come to parametric VAR. The most common risk measure is standard deviation. So higher volatility refers to higher risk and potential for higher losses. So using standard deviation and some assumptions about returns, we can create a confidence interval or probable distribution of return. So this is according to VAR is the chance of losing a potential amount for the holding period. Our holding period may be 1 month, maybe 15 days, or with a certain confidence interval or confidence level. So whenever we say confidence interval, I hope all of you have done so much on statistics and econometrics. Can anyone say what do you mean by confidence interval? 95%, 99%, or 90%? What is this?
Sir, it would mean that we are any percentage confident that the estimated value would lie between the intervals that we have calculated. The true value would lie between the estimates of the intervals that we have created.
Okay, good. Anyone?
Just to add to that,
Yeah.
the same thing she said, given the fact that we know the mean of the data set, we understand what is the standard deviation of the data set, and we are expecting that, we are assuming that the data set follows a normal distribution. And then what Cherry said.
Yes. So here we assume that data set follows the normal distribution. Then which is good? Whether 90% is good, 95% is good, or 99% confidence interval is good? Which is good?
Sir, it's subjective, depending on what you need out of it.
Okay,
We have generally taken 95%. I don't know what's the reason, but yes, we have generally taken 95%. So,
yeah.
Sir, I guess 99% would be ideal since the error measure would be just 1%.
Exactly. Chari is told the right thing. Here, the making a error, you have learned about type 1, type 2 errors. Chance of making a error is 1% when we are considering 99% confidence interval. Chances of making error is 1%. That's why we will be more confident when we are in 99%. So normally we take 95%. So chances of making error is 5%. Just take whether I have given you or other batches. Just take one example of introduction of COVID vaccine, or any of the introduction of new medicine for a particular disease. So before a medicine gets implemented, what the medical or this pharma company does, they test with the animals, especially rats, or they test with animals. So if they are getting like they are in the 99% confidence interval and 1% chances of error is there, and a new medicine, say Covaxin or any medicine, so Covaxin and Covishield, they're good. Suppose Nil vaccine, Nil has developed one vaccine, Nil vaccine. Okay, this Nil vaccine has been developed to cure some of the disease which is not been cured, or which has been undiscovered so far for the purpose of giving treatment. Now you say if Nil vaccine is having 99% confidence interval and 1% chance is there to making error, what error will come, or what is the outcome that will come?
And sir, as so the vaccine won't work to 1% of the people done in that
Yes.
sample.
So it will not
Or,
work to 1% of people. Yes, it will work with 99% people. 1% will not work, and even 1% may die. Okay, out of suppose say 100 people, 1 people will die. So if you are keeping 1,000 or 10,000, out of 10,000, if 100 people are getting died, then whether you will introduce that medicine, that vaccine?
yes, sir, because no one would be 100% sure that the any vaccine would work on everyone and anyone.
But yes, if it will not work, that is fine. But if it is getting if it is causing the death of some of the person, then whether it will be allowed to introduce that vaccine?
No, sir.
It will not be. So in medical science, people go with 0.00 uh, or we say 0% error, or almost 100% confidence interval, or it's above 99, in between 9900, because life risk is there. In our social science or in financial economics, so we go up to 95%, because here life risk is not there. Maybe it may happen that that particular analysis may work or may not work, but we go for 5%, and some cases also we go for 10%. But in medical science, they don't even go to 1%, because life risk is there. Let us analyze and then we'll come back with it. So uh, so this is the distribution. You can see conditional var is there. So this much percentage of var will come, the maximum loss will be there from our investment. Now, can you open the R file? We'll calculate. I think all of you might have calculated through Excel the var. Yes or no? Anytime anyone has calculated? Am I audible?
Yes, sir.
Yeah. So anytime anyone has calculated this var?
Sir, I think we have done it in previous classes.
In which subject?
I think in SAPM.
Okay, SAPM have done.
But we haven't, I think we didn't use Excel, but we used a normal formula to calculate VR.
Yes, sir. Yes, sir. Cherry is right. We were given the mean and standard deviation and so on and so forth.
Okay, now you calculate with a given level of data, you calculate a bar. So you use the hypothetical portfolio data that we have created during our risk return analysis of securities, portfolio risk return. So import that data. Now after you import, then refresh that, omit the NAs if NAs are there, and you calculate the mean and standard deviation from that list. Then we will use we'll calculate the 5% var, 1% and 5% var differently. Then we will see how much we are getting. Thereafter we'll move to historical var and see how much we are getting, and we'll compare this historical var and Gaussian var, which is assuming the Gaussian distribution or normality. We'll do that. So all of you have opened your file.
Yes, sir.
Okay. So just import on the
Sir,
data. Yeah.
so just a doubt. This hypothetical portfolio daily is what we have done for your assignment for you.
Yes, yes. The previously, not for assignment, we have done in class. We have done some portfolio risk return analysis. There we have taken 4-5 stocks and we have calculated. So in your folder, it is there. In your data folder, is
Okay,
this
sir.
the
Okay.
hypothetical portfolio daily. Okay, so that is nothing but the portfolio of combination of 4 or 5 stocks. Okay, so you take the portfolio return. Uh, so value weighted, equal weighted, two types are there. Okay, then you just refresh those portfolio returns and see if this normal, whether it is numeric or head or what is the type of this portfolio return. Then you convert that into data frame, that portfolio return, and calculate the portfolio mean. Okay, it's nothing but the mean of that portfolio return. Calculate the standard deviation. Standard deviation directly will come, or you can use library stats. Library stats is already inbuilt in R. Portfolio mean we got, and portfolio risk or portfolio standard deviation we got. Now we want to calculate the Gaussian bar, or the bar which assumes the normal distribution. What you need to give is you give your portfolio mean plus portfolio risk multiplied by 1%, that is Q normal of 1%, then multiplied by one number is there. What is this number? What is this number? This is your total investment. So out of your total investment from this in this portfolio, how much bar you will get. Okay. So you can run through and get the bar. Actually, this is giving all. It is in terms of how much in terms of rupee, how much loss will come. Then in 5%, how much you will get? In 5% bar, you are getting 20,000 of losses, or 20,534
So
losses.
could you just give us 1 minute to catch up, sir?
Which one?
So just 1 minute, sir, just to catch up.
Yeah. Should I repeat?
No, sir, I think that'll be fine. Just give us a minute to run up to here.
Okay. So if anyone is facing problem, you can ask.
Just a doubt. So what does unlist do?
Sorry.
Unlist code. It's if you can go to sir, where there's as numeric type of unlist.
Okay. Unlist. See, the type of portfolio return will come double. Just see that list of that thing. That is only unlist. The list of the variables will give.
Is it like seeing the data? Is that it?
Yes.
Okay, sir.
Then you convert it into numeric. Is that numeric? Or
Okay,
else
sir.
character.
Sir, I have caught up. As long as others are fine, we can continue.
So how many of you have run through? Can you raise your hand? Rasi, Neil, Himanshi, Ruma, Sahas, Sanika. Okay. Himanshi. What about others? Gaurav, are you there? Prasun, good. That Srivardhini has left or what? Jaideep, Gaurav, are you there? Anyone is facing any problem?
Not yet, sir.
Okay. Okay. So you got the 5% and 1% VAR, whatever is multiplied with your total investment. Okay. That is what, if you will not multiply also, you will get the percentage, but multiply with your total investment, so that in terms of rupee, how much VAR you will get. Now, okay. For historical VAR, take this Amazon data that is there with you. This data folder, you have all these data, Amazon, Yahoo, and IBM. So we'll use these three, IBM, Yahoo, and Amazon data. Just read that data and calculate the return. So return calculate, use this delt function of quant mode. So quant mode, you have to open, or you have to open through library. Then you get the delt of adjusted close, or the adjusted closing is good representation of the closing price, because in adjusted closing adjust with the corporate actions. Okay, so instead of considering closing price, always you consider adjusted closing price. If you are downloading data from NS website, you will not get adjusted closing price, but from ProS you will get, and from Yahoo Finance you will get. Now you calculate the return of that Amazon. Okay, so that adjusted closing price column. Then you calculate the return of Yahoo. Then you calculate the return of IBM. Now combine all the three returns into one through cbind. Once you combine that, you will get the return of all the IBM and Yahoo and Amazon. We are doing -1. Why -1? Why -1? Can anyone say?
So because to get the rate of interest would be 1 plus r to the power something. So one we have to get r we have to -1 in the formula.
Anyone? Why -1? You just see this IBM return. This IBM return, you are getting NA. First one is NA because you want to get PT by PT -1. The PT -1 for 1 is not there. So you will get first row NA. Now if you will consider that data for analysis, you will not able to do, because that row itself is NA. Okay, now we are deducting, or we are removing this first row. So this left hand side represents row, right hand side represents column. So we are just deleting this first row. That's why it's -1. All of you are clear?
Yes, sir.
Okay. Now you can just rename like Amazon return, instead of 1, 2, 3 column. You can rename Amazon return, and so still 1, 2, 3 are coming. So instead of 1 to 3, anyone is getting name here in the column?
No, sir, we're getting 1 to 3 only.
Why this paste is not happening?
So you may not have to do paste. You can just do names of red data, and without paste also sometimes it just works. So that C will be required. That C will be required.
Something has happened. Yahoo return, IGN return.
Sir, remove the extra bracket.
There is extra. Oh, yes, yes, yes. No, still it's not coming. Anyone got?
So just a question: is this red data saved as a data frame, or is it? Because if it's saved as a C bind, then I think names does not work, and you may have to do that dim names or
No,
something.
no. Team will give you number of rows and columns.
Yes. No, sir. Sir, if red data is not a data frame, then I think that there's a different way of naming it, sir.
Sir, use call name.
Call?
Well names.
Yeah. Call names, right? 1 second. I'll try one.
Yes, sir, it work. Call name. Use call name. And remove the date, sir.
That is what I was thinking. Yes. Now it came. So return data 1 is not. Yes, call names. So this R has some updates every 2 to 3 months. They update it. Okay. So now we have renamed our columns, and we'll use those for our calculation of var. Okay. You can write that CSV, or directly you can use that. Now, suppose in 3 different, say, portfolio, or 3 different, in one portfolio, 3 different securities are there. We'll use this many percentage of money to invest. How we'll get the portfolio value? Okay. Now, you can get the portfolio value. What you need to do is, you need to get the return data, then calculate the simulated portfolio return, and using the portfolio weights. Okay. So we'll get the portfolio return. This again. Okay, return data v1, v2, v3 we are using because our names are different. So use return names.
So what is happening? I'm a little confused right now.
So we want to get the portfolio return. Okay, for that we are using that return data that we have generated now for 3 stocks. So we want portfolio return. For that we'll use return data of each of these columns. So the column name is Amazon return. Then Yahoo return. Instead of v2, just write Yahoo return. Then in v3 it is IBM return. So we'll get the portfolio profit and loss that we will use to get the historical VAR at 1% and historical VAR at 5%, or 99% VAR and 95% VAR. Neil, you are getting?
Yes, sir. You are multiplying each of the weights with the expected
Yes.
return.
Yes, yes. Okay, how many of you got up to 5% historical VAR? Please raise your hand.
Sir, up to where, sir?
5% historical VAR value up to this. Chati, Ruma, Subham, Sahaj, Neil. Okay. What happens to others? Gaurav? Are you there, Gaurav? Or simply you have raised hand? Last time I was asking. Yes.
Sir,
No,
can
sir,
you
I'm
please
there.
show the code where you have changed the names to like
So
Amazon?
names here instead of V1, V2, V3, I just
Sir, in the above part where you did some modification now.
okay.
Yeah,
Column
just
names.
for 5 seconds.
So I'll just paste it in your chat box. You can use.
Thank you, sir.
How many of you are not getting, means you are facing some problem? Please raise your hand. Neil, you got it, right? Rasi, what is the problem?
Sir, since you have changed those names, so I'm not getting the output.
So now you
Right.
can change those names.
Yes, sir, I have changed them to that Amazon.return, Yahoo.return, but now it is showing NA values.
NA values. So this
Like it
NA
is giving NA as the output.
no, still then it is not changed the name. Can you check whether this name has been changed?
No,
Or
sir, I'm talking about the below code where we have done the simulated portfolio returns.
Uh,
This 87 line code number. Yeah.
it's correct, but these returns are from here only.
Yes, sir.
Have you changed here the name?
Uh,
In the 69th row, Just
Yes, sir, it is same. I have taken from there only.
can you share your screen quickly?
Yes, sir. Sir, actually, you are presenting already, so.
Sorry,
Sir, you are already presenting the screen.
still you can also present. Okay.
So I hope the window is visible.
Yeah, it's coming.
So do I need to change here again, like in this code? Here it is showing the NA, whereas you are getting some.
Can you go up?
Yes, sir.
Can you just say head return data? Your V1, V2, V3 is coming, na?
Oh,
The names has not been changed. First you run that column names. Now still one second. It has been named incorrectly. So before Amazon return, just write down date in double inverted comma. Start. Then after date, give one comma. Yeah. Just run through. Yes. Now it will work.
okay. Thank
Now,
you, sir.
now, now run through.
Yes, sir.
Yes.
Thank you,
Okay.
sir.
Welcome. Okay. All of you got it. Anyone is facing problem? Me here.
So I'm working with different laptop. This one doesn't have an R, so I'm just watching what others are doing.
Okay. You can download it. Yeah. It will take 2 minutes only.
So it's a very old laptop. Mine is for repairing. So
Okay.
just,
Jaideep. Okay.
Yes, sir.
Now
sir,
you
I
are
have a
getting.
request. Sir,
Yes.
is it possible for you to provide some R literature so that we can learn coding and all? Because there are many codes in R, so it is difficult for us to learn.
Okay. Our literature. Okay. I'll send you some.
Okay, sir. Thank you.
Yeah. Well. I think one book I have sent to you. No.
No, sir, not.
Okay. Today I'll send one link to the book you can download from the PDF drive, or if it is there the soft copy, I'll also download and send. So you can go through that book. There are so many R for finance, or R for financial analytics, or R for statistics. There are so many books are available. I'll give you some of the books. Yes. So up to calculation we have done. Now we'll plot that. We'll plot that bar. Okay. So that we'll get that distribution and say whether we are in 1% or 5%, is how much is our profit or loss. Okay, how much is our profit or loss. Now see, this is 5% of 1 day var, is 1% of 1 day var. Then we have simulated P&L and normal distribution. So in that simulated, we have given some hypothetical examples and done that. So you can see where this 1% and 5% VAR are placed in the distribution. So if anyone asks you to calculate VAR, either historical or Gaussian VAR, you can now calculate. Yes or no? Can you calculate now?
Can you please repeat your question?
Yes.
Can you please repeat your question?
The question is, if anyone asks you to calculate Gaussian VAR or historical VAR, can you calculate?
Yes, sir.
Yes, sir.
Yeah. Now, another thing is expected shortfall. How many of you have heard about this expected shortfall? Can you tell how many of you have heard? Yes. Yes, Cherry, you have heard. What is this expected shortfall?
Sir, it is a risk measure, a concept that is used to measure the risk, the market risk or the credit risk of a portfolio. So the expected shortfall at at level X% is expected return on the portfolio. In the worst X% of cases, it is an alternative to value at risk.
Yeah, expected shortfall is over and above value at risk. Okay. Suppose I am getting say minus 12% or 12% of value at risk, but what is over and above or beyond value at risk? How much loss can happen? So who will guarantee that we will not cross the value at risk boundary? It may go beyond value at risk boundary. Yes or no? So those whatever will go beyond value at risk boundary is called as expected shortfall. Okay. Now we can do expected shortfall for Gaussian VAR, expected shortfall for historical VAR. Okay. And we can see how much we are getting expected shortfall of Gaussian VAR and expected shortfall of historical VAR. Okay. So then we will compare the VAR and expected shortfall. We will understand which is giving us maximum losses or maximum loss probabilities. So we can say probability of maximum losses. Now you come with the Gaussian VAR or Gaussian expected shortfall, that is and historical expected shortfall. So you use this. This is your portfolio value. Okay, this is the investment that you have made. Then portfolio mean portfolio risk that you have calculated, and Q norm is 0.01, and now we'll use that for expected shortfall. Okay. Now a expected shortfall of 1% VAR is 36,061. Now expected shortfall for 5% VAR is 28,150. So like that you can get expected shortfall of historical VAR. Okay, historical VAR as well as 1% as well as 5%. So at 99% or 1%, you are coming out with 63,000, but at 95% it is 33,000 plus. So in a simulated portfolio that we have created one simulated portfolio, we'll also see simulated portfolio how much we are getting. At 1% and 5%. Anyone is getting this es.pnl? Okay, here this column. Now it will work.
So where did you make the change? I'm so sorry. That call
Yeah,
name.
I'll go back and show you. Here in 92 or 91, this simulated code PNL.
Got it, sir.
That paste it is happening, no? Code PNL is happening, but here it is that port PNL is not getting read through. Here.
Sir, port PNL should be directly written, sir, I think.
Instead of this. Still it's not coming.
So did you make any changes around 140? Okay, no, that's fine.
No change. Only this port PNL. Are you getting Neil?
So at 151, just give me a second, sir.
Yeah.
So in my code, it's not there. So do you want me to write it?
No, it is not there. I have just written. No,
All right.
I'm saying whether you are able to get this one, 152 or 150.
153, 154. All right, just give me a second, sir. 153, 154. Yes, sir. I'm getting three values: 29532.974, 5401, 164409. Then उसके बाद error in 156, 157, 158. No, 158 has run, but 156 and 157 I guess my codes are a little up and up down. So for you 153, 154. For me, those are coming as error.
Mm-hmm. Anyone is getting?
So sir, the error is that it is not an atomic vector. It's saying.
Then we'll convert it into vector.
No, no. So sir, I think this operator is invalid for atomic vectors. So maybe it is already a vector, and oh sir, I'm a little confused.
1 second, I'll just.
Sir, I'm not even being able to call port PNL.
That is one mistake. That is what it is happening. For that only we are not getting simulated portfolio port PNL.
Same dot port table.
Port PNL, na? Same dot port PNL is coming. Yes. Yes. So now it will work. Just allow me 1 second. I'll just try, then I'll tell you what to do. We are here, right? Okay. So instead of that PNL, just use that sim dot port PNL here. Okay. So I'll just send this to. Okay, use that simulated portfolio. All of you are getting?
Yes, so the plot, right?
No, plot though we have done. Now this one.
So code 154 and 155, how should we improve it? Because mine was not running.
Not running. What error it is coming?
So the same error that I've not made any changes. Am I supposed to make any changes?
Yeah, in previously, somewhere you need to change that. You can in 91, 92. You
No
can
changes. Just write sim port PNL.
just
Yes, Jadip.
Just write sim port PNL instead of that. ESPNL, remove it ESPNL and simply write sim.port PNL.
I did that only, but I'm also getting error.
Sir, please.
Sir, could you please
Like,
show the?
yes, sir, please show.
so should
Sir,
I send you this complete file?
oh, yes, sir, if possible, please send.
Yeah. Yes, send. Just check that. I'll just take 2 minutes. You just try to that. I'll just come back. Okay, all of you got it? All of you got it? Sorry? Neil, you got it?
Yes, sir. We saved
Terry,
his
your
name.
mic is on.
My mic is up.
Sir Cherry, her mic is on.
Sorry, just mute yourself. Cherry is attending 2-3 classes or what? Some students. I think you are coming back to your campus, right?
Sorry, sir.
You are attending 2-3 classes, Cherry?
No, sir. I went to my parents' room with the laptop and the TV was on there.
Okay. And when your physical classes are starting?
So maybe next sem. There is no clarity on that front.
Okay. Most probably next time it will start. Okay. So all of you got this part, like the expected shortfall of 1% and 5%. Got it? Yes or no? So will come this expected. You got it or not? Neil?
The R file, yes, sir. I've got the new R file.
No, the result you got it or not?
So once again, I'll have to run the code again because I have to set my working directory and everything.
Sir, in this code of 154 number code, I am getting an error in the updated R file that query LHS to a list.
Yes, the same error I'm also getting, but in my previous file, like I've made the changes there only.
But for me, that error is not coming. I think you are using my updated file, right?
Oh, yes, sir.
You see, in front of you only I am running. It's not giving me any error.
Rashi, is the updated file giving you error also?
No, actually, I've made changes in the previous file only because of the notes and
How
everything.
many of you are getting error? Can you raise your hand? Neil, Muskan, Rasi. What about others? Cherry. 153, 154. Okay, then we'll see in next class this. If any problem is okay. Later part you just see. Later part will not take that. Shortfall 1. Shortfall 05, shortfall 1. Are you getting?
Yes, sir, these values we are getting.
But after that, this average losses are coming in. Now, there are some error we have done. Argument is not returning an. Okay, we'll do it this calculation part in the next class. Let us discuss about the assumptions and say what are the benefits of this parametric var. So the assumption is asset returns are normally distributed with known mean and standard deviation over a specified period of time. Then the covariance or correlations among assets are known for the same interval. And for normality, what do you mean by normal? Can anyone say?
So normally distributed, sir.
Normal market condition. Yes, first you say what is normally distributed.
So like there is no too much volatility, sir. In the normal market condition, everything is, sir, like the inflation, interest rate, and sir, macroeconomic indicators
Not
are
so
like.
much volatility. Suppose say
Yes,
you
sir.
see extreme situations during COVID or financial crisis, those are not normal market conditions, but other than extreme situations, so there will be no much volatility. So if any extreme situation are there, then we allow or we examine them separately. All the extreme market conditions, because extreme market condition will give us a different kind of result, and all prediction fails in the during extreme loss. So therefore, bar is meant to show what can happen to the portfolio on a day-to-day basis. What will happen while analyzing any part of thing? We should always be aware about this extreme market conditions. Either we consider those conditions as a structural break or a separate period analysis we do, or we will be silent about those periods. And for what are the inputs that we required for bar calculation? Market values of all securities in the portfolio, then their volatilities and correlation between them. And the assumption is that movement of the component portfolio are random and run from a normal distribution. Okay. So the Z distribution that you are talking, we are getting like mu minus Z alpha into standard deviation. That is how we are calculating the parametric bar. Okay. So if you calculate this parametric bar, market value and Z statistics and alpha, then we get for 5% of 1 year or 5% of 1 year bar, we get this much percentage or this much value of losses that are expected from our investment. Okay. Now, if it depends the what is the market value. Suppose compute 5% annual bar of say $1 lakh portfolio with an annual expected return of 8% and 12%. For 8%, we'll see how much we are getting bar, and for 12%, how much we are getting bar. So like this, you have done the calculations previously that you are mentioning. Whenever mean and standard deviation are given and total value of the portfolio is given, how we will calculate the bar.
Sir, I have a doubt, sir.
Yes.
Like, how can we, sir, actually interpret the minus sign? Like, if it is positive, then we can say that the maximum loss that the company can incur at 0.05% significance level is
नहीं मेरी क्लास
11,000.
चल रही थी बाहर मैंने कहा और अर्शी का फोन
Sir, hello.
Yes, Terry.
So actually, her mic was on, sir, by mistake. Sir,
Okay.
can I
Yeah,
ask again, sir?
yeah.
Sir, actually, sir, how can we interpret the minus sign that is in the, sir, like minus 11.74%, sir? So,
Yes.
sir, like
Yes.
if it is just positive, then we can say that the maximum risk that the company can incur at 0.08% level of significance is 11,000. Sorry, 11,7400. But if with the minus sign, how can we, sir, interpret this?
Okay. Neil Muskan, what is your question?
Sir, I just wanted to ask about this minus 1.645. From where did this 1.645 value came from?
Okay, that is just statistics. Yes. Then Neil, you have.
No doubt, sir. Actually, some
Okay.
error had come, so I raised it at that
Okay.
point.
Okay. Neil has given very good example on positive bar. Can you repeat that, Neil? Shubham is having that doubt.
Yes,
Sir,
sir.
I have clear concept with the positive bar, but I cannot actually acknowledge the concept of the negative bar, sir. The minus sign, sir.
Okay,
Like
just
minus.
Neil repeat about this positive and negative. Yeah.
Okay.
So VAR at the end of the day is the worst case possible scenario. So that can be positive or negative depending on whatever is your investment. So like first I mentioned the positive case, which I think you agree with now, the bonds, government bonds, and the next, let's say, is something like I'm investing in some stock, let's say Reliance stock, and I'm going to invest for 1 year. Now there is a worst case scenario that my investment might have negative returns after 1 year, exactly after 1 year. So that is the negative bar.
Okay.
Neil,
Okay, got it,
in the
Neil.
bonds one example, did you mean like instead of getting 6% rate, we'll be getting 4%? Basically, we're not getting the 2%.
uh, वापस पूछो please.
Sir, can you just repeat the bond wala example once again?
बॉन्ड वाला.
Yeah, yeah.
हाँ, तो उसमें आई एम सेइंग कि लेट्स से 6% इज द गोइंग रेट. ठीक है, सो नाउ वार talks about it in two ways. One way of talking is that 5%, or one second, I have it written here somewhere. Please hold on. Either it is the worst case scenario, or it is a scenario which is very unlikely or will never occur. So now the thing is, if I've taken a government bond for 6% nominally, then it is nearly impossible for me to get a 4% return on that. Especially, let's say, a country like India, which has been historically good with keeping up with the bond rates, right? Stable country. So 4%, I'm just giving a random number of 4. So that is what I'm saying, that 4 is extremely unlikely. Only if India goes into a state of, let's say, war or something like that, will that happen.
Okay, okay. Thank you, Neil.
Shubham, are you clear or still you have doubt?
Yes, sir. Yes, sir. I'm clear, sir. Thank you, Neil.
So, with see, VAR is a very simple concept, but it has wide application, and there are stages of VAR. Okay, this from simplest form to complex form of VAR are there. Again, you can also see there are so many research papers. They compare this expected shortfall and Gaussian VAR and historical VAR during this COVID period. So many papers has been developed as well. Those who are interested into research, you can go through and start doing similar kind of work. Also, there are so many countries they have examined only by considering these extreme parts, like the COVID period. Okay, so we'll do it in next class. The rest part, is it fine to all of you?
Yes, sir.
Yes, sir.
Okay. One
Yes.
second. भैया वो जो लॉक है ना, just hold for 1 minute. I'll take attendance. Okay. Okay, today is 23rd, right? So who are present? Can you tell one by one?
Muskan Garg, sir, FE 2027.
20.
No, sir, 20,
Muskan Garg,
28.
28. Okay.
Sir, Mir Sakarika, 27.
Mihir,
So Cherry Chavla.
Neil 29. 30
Pratik Maheshwari.
30 in your list.
Neil 30 or 29?
30, sir. So I don't know why it's changed in this. I'm
Sir
2029.
Pratik Maheshwari.
Pradeep,
So Cherry Chavla.
Pratik Maheshwari. 1 second.
So 39 Rashi
They will
Jain.
be up, no?
So 14 on your list. Cherry Chavla.
Sir, Kriti Marba 23.
Sorry?
So Himanshi Kriti Marba 23.
Himanshi. Himanshi, you are present, right?
So
Priti,
Sir, Kriti 23.
Kirti. Okay.
So 39 Rashi Jain.
Prasoon
Sir
Sharma.
Ruma. Sir Ruma 41.
Okay.
Sir 31 Prasoon Sharma.
2 minutes. Yes.
32 here Prasoon Sharma.
Sir, Gaurav Kadam.
Subham Kumar 2047.
Subham Kumar, Subham Jain, Subham Kumar.
Yes,
So
sir.
Sanika Thakur, 50.
Thakur Sanika. Yes. Then
Sir, Shubham Jain also 45.
Subham Jain. Yes.
Rahul 37.
Rahul.
Yes, sir. Rahul Goswami.
Okay. Anyone?
Sir,
Sarvesh
Gaurav Kadam.
Bagal.
Service?
Sir, 12. Sarvesh Bagal. 12. 2012.
Okay.
Sir, Gaurav Kadam. 17.
Gaurav. Gaurav, today you are not active. What happens?
Just like that. Nothing special.
24.
24.
2024.
Jai. Okay. Then all done. Okay. Thank
Sir
you.
Sehaj as well. She might drop down because of the internet
Who?
issues.
Who?
Sehaj.
Sahels. Okay. Okay. Thank you all.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.